Welcome back to the first real estate market update for the greater Milwaukee area in January 2022. I hope you had a great holiday season. We have wrapped up the year and have final numbers, so we're going to take a quick look at this. It has been another record-breaking year for Milwaukee's real estate market, and that's interesting, but more importantly, how is that going to set us up for the spring season ahead, and how is that going to set us up for 2022 in general? I also want to take a look at three topics that you are going to hear a lot about this year, not only from me, but also in the news. And that is going to be interest rates, inflation, and inventory. So that's three big topics we're going to cover today. But before we get there, let's take a look how December came in and how we wrapped up the year. So pretty much as expected, December has been a very, very strong market, untypical for a December, I'd like to say. 2,500 homes sold here, and you can see that number homes sold is almost as big as the inventory that we had on the market. So up 3% for Milwaukee, pretty much the same thing. We sold almost everything that was listed on the market. And the crazy thing is, I always point this out, here is December 2015, which was one of the last normal years, 12,400 homes in inventory. Now compare these numbers here. We sold more than we did back then with a fraction of the inventory. Prices remained pretty stable since November, so not much change here. 260 is now the median for the total MLS area, and for Milwaukee County specifically, 215,500. So with that, we have sold 9,344 homes in Milwaukee County, almost 10,000 units, and that's 7% up over last year, which has been a record before. So every year we're burning through new records. People are always saying we have no inventory, and I have to keep pointing this out. We do have inventory. It just moves quickly. So you have to have the inventory, otherwise you can't sell it. The US in general, national average on price is now $312,000, 728, and that's up 19.4%, so almost 20%. If you compare this with Milwaukee County, up 11.6%, so we went up not as aggressive as the US average, and I think that is actually a good thing. All right, let's take a look at listings here, because we have seen a sharp decline in the fourth quarter. You can see the 2021 numbers here, and these are number of new listings, and we're dropping down. We finished the year in December with about 400 new listings, and we had a little bit over 1,000 in the middle of the year. Now compare this with 2015. We were basically over 4,000 and then seasonally dropped off as every year. I think the seasonal drop off is also because the issues that we have with coronavirus, with Omicron. So I think that is amplifying this issue. Of course, part of it is seasonality, but the difference in the sheer numbers is just huge, and it illustrates really how low we are in inventory. So fingers crossed for January and for February. Hopefully we are going to see February numbers come in strong on inventory, because there's definitely a lot of buyers in the market. Next topic, inflation. So latest numbers, I'm sure you've seen it in the news. Now it's everywhere. Consumer price index came in for the year at plus 7%. You can see here on the chart that is the highest that we have been. You have to go back 40 years. And inflation is going to be a key topic for this year, because it's basically a devaluation of the dollar, which helps all the hard assets to go up in value. So real estate, as you know, is a hard asset, and it generally benefits from a declining currency. So inflation is going to remain a topic for the foreseeable future. Let's take a look what's going on with inventory. I have here numbers from December 2021, so just recently, and inventory is down compared to a year prior, another 26.8%, which is almost unbelievable, because inventory was so low in 2020 that it was almost not conceivable that it could go down even further. So you can see here on the chart, we are down across the nation. There's only a few blue spots. Almost everything else is orange or red. Florida leading the pack here, down with minus 48%, but also shortages here up on the northeast side. And in Wisconsin, we are down 17.9% on inventory. Why is that? because we have not built enough houses. I've extensively talked on this channel about it. We have not built enough houses after 2008 when the mortgage crisis happened. A lot of the builders and developers went out of business. A lot of the contractors went out of business. So we basically underbuilt for more than 10 years. And now this is catching up to us, because on a normal year, we are building an average number of homes. And if you overbuild for 10 years, after 5 or 6 years, that gap starts showing. And that's what we have right now. Depending on whose statistic you believe, we are about 4 to 6 million houses short across the US, about 5 million houses. And it's not easy for the developers and builders to get production up because they are short in labor. It's not easy to find contractors. Most of the contractors are 50 years and older. We don't have a lot of new young people going into the trades. And then, of course, on top of that, you have lumber prices that hit us really hard last year and are still elevated. And then you have the whole supply chain. So anything that you want, from flooring to windows, everything takes longer. So makes it extremely difficult for builders to get production up. The cost is very high too of building new construction. And with that, people are looking to buy maybe an existing home instead of a new construction. So it will take quite a while before we're getting out of this construction hole. And experts are estimating about 8 to 10 years before supply can catch up with demand. So unless something really dramatic is going to happen, inventory is going to remain an issue for quite a while. Now, the flip side of this is home prices, because if inventory is low and buyer demand is high, that is driving up prices. We've seen this plenty last year, and as a result of this, home equity is growing. These are only Q3 numbers I have here from CoreLogic. They haven't finished the year yet. You can see Wisconsin, $28,000 in equity gain. By the end of the year, it's going to be a little bit more. So on average, across the nation, $56,700 in equity gain for homeowners. And a lot of that on the East Coast and on the West Coast, California here, $120,000 almost. So there's huge gains in equity here. But on the flip side, that also means that home prices are up. So if you're on the buying side, if you're looking to buy a home, it is becoming incrementally more difficult year after year to get a house under contract because prices are going up. Now, what this is creating also, it's creating a tendency within the US that the Midwest is becoming more attractive price-wise. And I'm feeling that in my business, because I have quite a few people reaching out to me every week that are relocating to Milwaukee from other parts of the country. And from our point of view, prices are up and homes have gotten expensive. But from their point of view, Milwaukee is still very, very attractively priced. Cost of living is low. And we are going to be, we have been more on the radar last year. And I think this trend is going to continue into the next years. Now let's talk about buyers. Here I have numbers from showing time. Usually I'm showing you a chart here that shows you exactly week by week. I'm taking a different approach here because I wanted to show you a bigger picture. And this is a comparison of the November numbers from the last 5 years. And you can see that buyer activity here on the gray bars has been relatively stable always, and then it started jumping up significantly. That's an almost 50% gain here in 2020, and it jumped up one more time in 2021. So buyer activity remains extremely high, compared to every historical average that we have. And we are not seeing buyer activity declining. That has to do, of course, with the shift in demographics that we're seeing. Millennials have become the number one group of home buyers. They have decided it's time to buy a home, and they are not going to abandon their plans as long as they can. So buyer demand is going to remain very strong across the board. But what has shocked me is how quickly things jumped into action this year. This is quite expected. We always see in January buyers come on the market first. Sellers take a little bit longer. So that creates an imbalance always early in the year. But it's quite difficult for me to convey what I'm seeing and feeling when I pull in on a showing on a Saturday and it looks like a Packers party with cars parked up and down the street, when you have not 3 or 4 parties show up for a showing, but when you have 32 people looking at a house on a Saturday. So that is something you have to see. I tried to take a picture. I couldn't get a good shot of it. So I'm trying to illustrate it here a little bit for you. And so what's happening is somebody making an offer and then a second offer is coming in. And at that point, a good listing agent will reach out to all of the other agents and will say, hey, guys, we have multiple offers on the table. If your client wants to write an offer, I need to have it by the end of the day, and it needs to be your highest and best offer. So everybody who is writing an offer at this point already knows there's multiple competing offers on the table, so they're going to write their offer as strong as possible because they already have that knowledge of multiple offers on the table. So in our example, what ultimately ended up happening is they ended up with 11 offers on the table. And of course, this was an extremely perfect house. Everything was remodeled, nicely done. It was priced even very attractive. So of course, this gets a lot of attraction in the market. There's a lot of people interested, a lot of people writing an offer. But what it also does, it creates this kind of competitive situation that has its own dynamic, and it really drives up the offer price. Only a small percentage of houses go this way. I have to stress this. Maybe the best 10 or 20% of the house is really good deal, looks very, very nice, everything updated, and it's also not priced too high. That's a big mistake that sellers are sometimes making because that kills the whole dynamic. Now, so what's happening with that is that everybody is writing their highest offer, and then one party gets the offer accepted. So that's great for them because they're off the market now. But that leaves the other 10 parties that have made an offer, it leaves them frustrated. And it's like being sucker punched when you write an offer on a house and you didn't get it. It's really frustrating. So they are still in the market, and they are going to be out there next weekend again, competing against each other and maybe against you for the next perfect house that they are going to find. So what does that mean in terms of being competitive? Number one is we don't go back and forth like you see it on TV, where they're negotiating and then you can make a counter offer. That's not what's happening. You make your best offer and then the seller picks your best offer. And one of the things that I find working with buyers that they have a hard time wrapping their mind around it sometimes is that it's not about what's fair, what's reasonable. It's about beating out the other 11 guys. So if you really want to go for such a hot listing, such a hot house, everything super nicely done, it's going to be competitive and you're going to have to deal with that. That's just what it is. When I'm the listing agent, this is the perfect scenario. So when I'm on the seller side, this is what I'm trying to orchestrate. And so now you have these 10 people that are going to be out on the market again. And what's going to happen is, of course, they're making the next offer even stronger, and they're considering things like the highest price possible, eventually even with an escalation clause to escalate beyond other offers. They may not include a home inspection, which you better know what you're doing if you do that, and a lot of people can get themselves in trouble with that. They are waiving financing, making a cash offer. Maybe they have a limited or no appraisal contingency in there, and if the seller needs it, they will offer flexible dates. So this is what a very competitive situation looks like, and that's why we have so little inventory, or that's caused by so little inventory. If a house is really nice and if it's priced well, then it's going to get very competitive. Again, not every house is going to be like this. There is a big chunk in the market that's selling in a more reasonable way, maybe with 2 or 3 or 4 offers. We've seen a few of those over the last 2 weeks. And then you have a smaller percentage of homes, maybe 30% of the listings that are actually not going to sell on the first weekend, not in the second week. They're going to sit on the MLS, usually because they're overpriced, even if they're nice. If they're overpriced, the market is going to let them sit. It's interesting how that works. Or the condition is just not good. It's just not a good house altogether. So that's basically the reason. And until inventory is improving, we are not going to see much of a change here. Now let's talk about forbearance, because that is a topic that I promise to keep tabs, because I'm still getting questions online, people saying, what about the wave of foreclosures? So forbearance was a program where the government would allow you to not pay defer your mortgage payments, make it later. And there was a lot of thought in the market that this would eventually lead to a lot of foreclosures. Why are we not seeing a wave of foreclosures? Because even if people cannot get back on their feet, with unemployment rate, being down low again, a lot of people are employed. So even with the economic environment that we're in, if you still cannot manage to make your mortgage payment, most likely your house will have so much equity that you can just put it on the market and sell it. You don't have to go into foreclosure. This is what people are always forgetting. Foreclosure is only the outcome if the house is underwater, meaning if there is more money owed on the house than what the house is worth. Then you have to go into foreclosure. It's going to wreck your credit for 7 years. So nobody volunteers to do that. And with home prices so high, there's really no need to go into foreclosure. We may see an uptick in foreclosures. Here I have a chart about distressed properties. You can see how high we used to be, 35% distressed sales, so that's foreclosure and short sale, and now we are down to about 1%. We're going to see a little bit of an uptick, but it's not going to make much of a difference. Just to the contrary, it's going to be very welcome inventory that we need in the market. All right, quick sidebar. So here is my monthly reading and subscription list. So everything that you are seeing in this video is basically a compressed version of the data and the information that I'm getting from these resources. So you can make smart and informed decisions when it comes to your real estate life here in the Milwaukee area. So if you like this information, please give it a thumbs up and support my channel. With that, let's take a look what we can expect in 2022. Like I mentioned earlier, there's a handful of topics that are going to be dominating the discussion this year. And the first one, without a doubt, is going to remain inventory. At the moment, it is seasonally very, very low. This is just typical for the beginning of January. It just takes a few weeks before sellers can get the home ready, get it cleaned, get it painted, get it staged. That just takes a while. So we are going to see more and more inventory throughout February and throughout March. But inventory in general is going to remain a hot topic this year. We are just not going to have enough houses to meet buyer demand. The next topic to keep tabs on is inflation. So the Fed has already acknowledged that inflation is not going to be temporary. It is becoming a real issue, and they will have to take steps to bring inflation down, of course, without throttling the economy too much. So they're talking about 3 interest rate increases this year, and of course, that is going to have an effect on the economy and also on the housing market. And then finally, we are talking about remote work. So remote work is here to stay. You probably know it from your own workplace, the changes that are happening there. And with that, of course, the demands that people have on their houses have changed as well. So some families need now 2 home offices, a space where they can work quietly and uninterrupted. I don't know if you can hear the contractors here. They're working on my house, talking about quiet and uninterrupted. So remote work is here to stay, and that's going to impact the Milwaukee housing market as well as a major trend in 2022. All right, let's take a look at mortgage rates. So here's a chart of 30-year fixed rates from 2018 until today. And yes, we are already running up. This chart is already outdated. As of today, we are at 3.45% interest rate from Freddie Mac on a 30-year fixed. But you can see, historically speaking, this is still a very low interest rate. So we have here the average of all 4 for the end of the year, Q4, still at 3.7%. So that is the official forecast, the official prediction we have for the end of the year. Given the fact that we're already at 3.45, I would not be surprised if we see rates going up faster, quicker. And I had a question, I think 2 days ago from Alex on another video. He was asking me what I think the impact on the market is going to be when rates are going to go up. And I'll give you my thoughts, but it's different than what you might be expecting. So here's a chart that basically shows you how much you pay on a $250,000 house if you have a 3% interest rate, how much you're going to be paying for principal and interest, and that's $1,054. So if the price doesn't change and only the rates go up to 4%, this changes to $1,194. So that's about $140 more. If the price of the house is going up as well, which could happen over the next few years, and let's say we're going from 250 to 290, then we're going from here to 1,385, which is, fortunately, did the math already, $331 in increase. So that is a substantial increase. And that's when a buyer gets hit with the double whammy of higher interest rates and higher prices, because home prices keep going up. Then it can become an issue with affordability. So as long as rates are not rising too fast and too high, when people have made the decision that they're going to buy a house, they're usually going to follow through with that decision no matter what the interest rate today is. It's, in my experience, not really a determining factor. What it will change at some point when rates are going up too high, it will lower their pre-approval. So it will lower the maximum amount that they can spend for a house, which will force them to buy a cheaper house altogether because they can't afford anymore what they could have afforded a year ago. So that is one thing that's happening. The thing that is unexpected, a lot of people are thinking that, okay, interest rates are going up, that should slow down the market. But what it actually does, it increases urgency. And I've heard this from a number of clients in the last 2 weeks. Everybody's talking about rates are going to go up and they want to buy a house. They want to get an accepted offer and lock in their interest rates before that is happening. So it's a little bit counterintuitive because you would think that with rates going up, that will slow down the market. At some point it will. But at the moment, what it does, it's adding urgency. People want to get a house under contract and lock in their interest rate. So I hope I answered your question, Alex. Let's take a look at housing affordability. This is for Wisconsin. This is from the WRA. And you can see that from December 2020 until last year, December, so a month ago, the affordability index has lowered from 223 to 194. This is specifically for Wisconsin. And so what this chart means, basically, I'll read it here for you. A value of 100 means a family with the median income has exactly enough income to qualify for a mortgage on a median priced home. So we have quite a bit of ways for this to go down until we hit 100 and the median family can buy exactly one median home. At the moment, the median family can buy almost 2 median homes. So will this keep going down? Absolutely, it will. It will accelerate because of rising interest rates, and it will also go down because home prices are getting higher. And the only other force that you have offsetting affordability is if salaries and wages are going up, and we're not seeing that yet, at least not fast enough. All right, so what's the home price forecast for 2022? We still have the official forecast standing at an average of 5.2%. Also here, I'm making the same footnote disclaimer here. I would not be surprised if we are seeing substantially more in Milwaukee and in the rest of the country for that matter than we have seen last year. The prediction for last year was too conservative as well, and I think they're making the same mistake here. So my default assumption for Milwaukee is less than we have seen last year, but maybe something between 8 and 10%. But we are definitely going to see this year in spring prices go up. It's just unavoidable with the shortage of inventory and the very high buyer demand that we're currently seeing. And with that, let's wrap it up and take a look at the crystal ball. What can we expect in Milwaukee for the next few weeks? So first of all, inventory is going to increase. If you're in the market right now and you look online and there's absolutely nothing to choose from, that will get better every week as we're getting into February and March. There's going to be more listings popping up. Not as many as we like to and not as many as we need, but there's going to be more than we have right now. On the other hand, if you are a seller, take advantage of the situation right now. There is a high level of urgency and a lot of buyer demand there. And if you're putting your house on the market now, timing-wise, it works out that you are going to be buying into a market that will have more inventory. As we're going into spring market, inventory will increase and buying is going to get easier with that. What's working against that is the interest rate. So, like we discussed before, interest rates are pretty much expected to rise. And the question is only how much and how fast. So we'll keep our eyes on that. But that is really driving a lot of urgency at the moment with buyers because they want to lock in an interest rate before it rises. On the other hand, look at the numbers. Going from 3.3% to 3.5% is not the end of the world. If you're stressing out over it, run your numbers. You will see it is not a huge change in your mortgage payment. And historically speaking, it is still a very, very good rate. A lot of people have bought houses and they were happy to get a rate under 5% just a few years ago. So still very good rates in historical context. And with that, if you have plans for 2022, please reach out to us, talk to us. We're happy to have the discussion with you. You can reach me on my cell phone. You have the number here on the screen. You can send me an email, or you can go directly on my website, onpointrg.com, and you can schedule a Zoom call directly on my calendar. My team and I are ready for you. With that, thank you very much for watching. I'll see you at the next one.